Okay, welcome back to my YouTube channel. So today I'll do a question 22 for the August 2024 mock. Yeah, I'll read the question straight away. The following information relates to Dawida Limited. Dawida Limited is considering purchasing a machine for production purposes. The machine will have a cost of shilling 75,000. The installation cost for the machine is shillings 12,500. and an initial investment in working capital of shillings 22,750. The machine is expected to have a useful life for 5 years, at the end of which it can be sold for shillings 20,000. The investment will result in an incremental revenue of shillings 47,250, cost of shillings 10,000 from the first year. Inflation rate is expected to be 3.5%. Tax rate is 25%, and the nominal cost of capital is 11%. Revenue, costs, and working capital are expected to grow as per the inflation. Required A, the net present value of the project. 2, profitability index of the project. Roman 3, internal rate of return of the project. Roman 4, return on investments of the project. Then part B, using graph, calculate the payback period of the project. Then part C, determine the sensitivity of the project to its net present value when revenue and costs are adversely varied at 8.5%. Yeah, so we'll do this question. So I'll start with analyzing the question. So I told that the machine was bought at a cost of 75,000. So the cost of the machine was 75,000. Then we add the installation cost. Installation was 12,500. Yeah, therefore, so that the total cost of the machine, which is the initial cost, will be the sum of these two, the cost plus installation. So it will be 87,500. So this 87,500 will also be the depreciable cost. Yeah, so that's what will depreciate. Yeah, so it's the depreciable cost. So allow me to extend that. Therefore, the depreciable cost is 87,500. So I'll go to the next item. We had initial working capital. The initial working capital will be equals to, you are given initial working capital of 22,750. Then the machine is expected to have a useful life. Yeah, so useful life of the machine, useful life is 5 years. Yeah, they're saying that the machine is expected to have a useful life for 5 years, at the end of which it can be sold for shillings 20,000. So that's the salvage value. Salvage value is 20,000. We continue. The investment will result in an incremental revenue of shillings 47,250. So revenue is 47,250. And the cost is 10,000. Cost is 10,000. Yeah, and this all revenue and cost emanate from the first year. Yeah, inflation rate is expected to be 3%. 3.5%. So the inflation will be 3.5%. Then the tax rate will be 25%. And the nominal cost of capital, that's the WACC, will be 11%. And they're saying revenue, cost, and working capital are expected to grow as per the inflation. Yeah, so that's okay. So we have done the analysis. So the last thing I'll do here before I prepare the table of income statement and investment income, what I'll do first is to get the amount of depreciation. Yeah, so I'll say depreciation. Yeah, so the depreciation, because they're silent, we use the straight line basis. So the straight line basis will take the cost, which is 87,500, the depreciable cost. Yeah, that depreciable cost. Then we subtract the salvage value. So allow me to start with the bracket. You subtract the salvage value, which is already there. Then you divide by the economic life of the machine, which is 5 years, the useful life. Yeah, so you'll get a depreciation of 13,500 for every year for the 5 years. So with that, now I can prepare the table. So I can prepare the analysis table, the income statement and the investment statement. So I'll start here. So allow me to do it here. Yeah, so this is what I will do. So I'll start with year 0. Yeah, for the 5 years. So you just go to series. You go to home, then you go to series. Sorry. You go to series. Yeah, then it's within a row. So my step value will be 1. So I'll stop at 5. Then you just say okay. And you'll have the years there. Yeah, so I'll bold this. Then I'll create the bottom border. So after that, then I'll start the income statement. I'll start with the revenue. So I just come and select it because already I've typed it. So revenue emanates from year 1. So you don't confuse it and place it here under year 0. So revenue, we'll have 47,250. But we are told that it was affected by inflation. So from the second year, this revenue will change. Yeah, so we'll have 47,250 times bracket 1 plus the inflation rate, which is 3.5. So I'll lock the inflation rate completely. The cell with the inflation rate, I'll lock it completely. So that when I enter, I'll be able to drag. Yeah, so that's the value that I have. So next, I'll just drag and those other values will appear automatically. So the next thing is cost. So the cost, the same. The cost for the first year was 10,000, but it was affected by inflation. So from second year, we'll have an inflation. So I'll multiply by 1 plus the inflation rate. But I'll lock the inflation rate, the cell with the inflation, completely. So that when I drag, the values will appear automatically. So I'll drag all the way. Yeah, so the next item here is depreciation. So I'll just copy it. It's here. So depreciation, it's 13,500 for the 5 years. It will be constant all through. It will be constant all through. Then now the next thing will be now earning before tax. So EBT, earning before tax. So the earning before tax will be revenue minus the sum of those two, cost and depreciation. Yeah, so earning before tax will be 23,750. So then you drag, you will get those other values. So allow me to create the top border. Create the top border. Then now we'll go to tax. Yeah, so the tax rate will be equals to, this is the tax rate, it was 25%. So I'll lock it completely so that I'll be able to drag with a lot of ease. Yeah, lock it completely. Yeah, then now I'll multiply this by earning before tax, which is here, but I'll introduce a negative sign before earning before tax. Yeah, so that I get the tax in negative. Yeah, so once you have that, because we are already locked, so you just drag, you'll get your answer. Yeah, so next will be earning after tax. Earning after tax. So the earning after tax will be the sum of those two. Earning before tax and tax. Then you'll have to add back the depreciation. So you add back this depreciation. Yeah, so you just come here and you pick the values the way they are and you drag. Then this will now give you the operating cash flows. Operating cash flows. Yes, the operating cash flow with the sum of those two, earning after tax and depreciation. Yeah, we are adding back depreciation because depreciation is a non-operating expense. Yeah, it's a non-operating expense. So we add it back to earning after tax because it's not an operating expense. It is non-operating expense. Yeah, so once you get that, you just drag. And here I'll have the operating cash flow. So I'll bold it. So I'll prepare the investment statements. I'll start with the initial cost or initial investment. So I'll just select, because we have done the analysis here. So we just select everything. So initial cost, this is the initial cash outlay. So it begins at year zero. At year zero. So we'll say equals. Then we put a negative sign before we select the value for the initial cost. Yeah, then the next will be the initial working capital. Initial working capital. That also begins in year zero. So it will also be a negative. Yeah, it's what you pump into the business. It's the initial cash outlay. Yeah, so that will also give us. But we are told under additional info here that even the initial working capital is affected by the inflation. So it means that it also grow from year one. So I'll pick this and I'll multiply by bracket 1 plus the inflation rate. Then I'll lock that inflation rate completely. I'll lock it completely. I'll lock it completely. So I'll enter that. Then I drag. Yeah, so those are the initial working capital up to the 5th year. So we'll now check for the changes in working capital. Changes in working capital. Yeah, so the changes in working capital. So we'll start from here. So I'll pick this and I'll subtract that. Yeah, so the changes, you just drag. From there, just drag, and those other values will appear automatically. Yeah, so the last item here will be the salvage value. Yes, the salvage value happens at the year end. Yeah, you recover the money at the end of the project life cycle. Yeah, so it will be equals to, it was 20. So we just pick it the way it is. It was 20,000. So that we have the project cash flows. We have the project cash flows. Yeah, so for year zero, we just sum these two. the initial cost and the initial working capital. Then for the second year, we'll take the operating cash flow. Then we add to the changes in working capital. Yeah, so we'll do that up to year 4. Yeah, but for the last year now, we'll pick the operating cash flow. We'll add to changes in working capital for year 5. Then we'll add to the salvage value. Yeah, that's the cash flow. That's the project cash flow. So that we get 54,520. Yeah, so allow me to highlight that so that you can see it clearly on your side. Yeah, so with this now, we can be able to answer the question with a lot of ease. So we start with the net present value, the NPV. Start with the NPV, the net present value. So I'll do it here. Sorry. So my NPV equals to NPV. Yeah, so we'll take the rate, which is the WACC. Then we select from year 1. Select from year 1. Then you close the bracket. Then you add back the initial cash outlay. Then you enter. So it will give me 20,908. So allow me to reduce the decimals to decrease. Yeah, let me have an all figure. Yeah, so it will give me 20,908. So the next thing that I have to calculate is the profitability index. Is the profitability index. The profitability index, that's what we are supposed to do. So I'll just write it as PI. Yeah, so PI, this is the formula. You say equals to, then you put the bracket, then you pick the project cash flow for year 0. The project cash flow for year 0, but you change it to positive. So I'll introduce a negative sign before that. Then I pick it. Then you add it to NPV, which is year. Then you close the bracket. Then you divide by the project cash flow for year 0, the initial cash outlay. Yeah, this value. So I'll also change it to positive. So I'll put a negative sign and pick it once again. Then I enter. So the profitability is 1.18. So it's more than 1. So it means that the project is viable. That's how you analyze the profitability index. So it's greater than 1. It's 1.18. So it's a viable project. Yeah, so the next thing we'll calculate is the internal rate of return, which is IRR. Yeah, so the IRR, you just say equals, then you type the formula IRR, then you pick the values from year 0. Yeah, you just pick all the values, then you close the bracket, then you enter. So IRR, we have 18%. We have 18%. So then another thing is the return on investments. Return on investment, which is ROI. Yeah, return on investment of that project. Yeah, so return on investment, this is what you do. The formula for the return on investment is that you pick the NPV and you divide by the project cash flow for year 0. Yeah, you divide by the project cash flow for year 0. Yeah, the cash outlay. So we'll change this to positive. So I'll put a negative sign, then I'll pick it because the project cash outlay must be positive. So you divide NPV by the project cash outlay or the project cash flow for year 0. Yeah, it's easier that way. Then you enter. So we have 0.18. So let me change it into percentage. So percentage, it will give me 18.96%. So when the examiner asks you, which is the most viable measurement, is it the internal rate of return or the return on investment? So you'll choose the return on investment because it's the most accurate. Yeah, it's most accurate. 18.96%, almost 19. So the return on investment is the most accurate as you compare to internal rate of return. Yeah. Yeah, but for both, the projects are viable because even the internal rate of return is more than the WACC. Yeah, WACC is 11%, but this is 18%. Yeah, then we go. Yeah, I think I'm done with part A. So part B of this question, that's how we are supposed to do part A. So part B of this question, they're saying, using graph, calculate the payback period of the project. Yeah, so the payback period of the project using the graph. So this is what we are going to do. First, I'll calculate the payback period. I'll calculate the payback period through the formula, the Excel formula. Then I'll do the graph and you see how we go about it. So the payback period. First, you can't do payback period without having the cumulative cash flow. So we'll introduce something we call cumulative cash flows here. Cumulative cash flows. So cumulative cash flows, we just cumulate the cash flow. So for this year 0, we'll just have negative 110 to 50. Then for the second year, we'll have this, but now plus this. Yeah, so that from here, I just drag. Yeah, and we'll have the values all through. So at the payback period is where now the cash flow, the cumulative cash flow changes from negative to positive. So when I check my workings here, the payback period is between the third year and fourth year. So it has to be 3 point something years. Yeah, between 3 and 4 years. Because here we have negative 15,818, but here we have 17,649. So let me do it first through the formula. So the formula just say equals to, because it lies between 3 and 4, you just say equals to 3. Then you add the absolute. You select the absolute function plus the absolute. Then you take the cumulative. You take the cumulative cash flow for year 3. You select the cumulative cash flow for year 3, which is here 15, negative 15,818. Then you divide by the project cash flow for year 4. Yeah, because it lies between 3 and 4. So divide by that. Then you just close the bracket, then you enter. So when you enter, it will give you 3.47, almost 3.5. Huh? Yeah, so let me even decrease the ratios, the decimals, and see. Yeah, it's 3.5. So the payback period was 3.5 months. So it means that the payback period was 3.5 years. Yeah, the payback period is 3.5 years. But the examiner was asking us to use the graph. Yeah, to use the graph to present using graph calculate the payback period of the project. So I've done it. I've done it manually. Yeah, so we want to confirm if it is true through the graph, that is 3.5. So this is what you do. You know that for you to get the payback period, you determine the payback period by checking the periods. The period is from 0 to 5, the 5-year period. Then vis-a-vis the cumulative cash flow, because you can be able to analyze this only when you check where cumulative cash flow now changes from negative to positive. So this is what you do. Just come here and say the number of periods, or just say periods, yeah, not number of periods, but periods. Then here we have cumulative cash flows. Yeah, so period we have from 0 all the way to 5. So let me just fill it here. So it's a column, so up to 5. Then you enter. Then for each year, we have the cumulative cash flow. So I'll just select them here. That. Then for the next year, it is that. For the next year, it is that. For the next year, it is that. Then for the next year is that. You just select. And for the next year is that. Yeah. Yeah. So with this information, you just select all this. then you go to insert and you'll be able to get the graph. So I'll select all this, you highlight, then you go to insert, then you go to recommended charts. Yeah, and you have to be guided. Don't go for pie chart because pie chart will not give you the correct presentation. It's recommended, but don't go for it. Don't go even for this clustered column charts. Huh? Go for this. Huh? Go for this one. Yeah, so the scatter. Yeah, go for the scatter. So you say okay. So once you say okay, let me put it down here. Yeah, you can see the graph. The graph, you can see it's moving. At the point when it touches, it changes to 0. Yeah, it moves from negative to 0. At the point that now it's positive, because 0 is positive, you can see that it's crossing the line between 3, this is 3, and 4. So it's crossing the line at 3.5. Yeah, yeah, immediately at the center. Yeah, so that's the payback period. So let me just write here payback period. Yeah, so that's this is the presentation for the payback period using the graph. And you can see it's between 3 and 4. So it's 3.5 at the center. And that's what we got when we calculated using Excel. So this is what the examiner was asking for you. And with this, you get your 4 marks free. Yeah, so this is how you do payback period using a graph. Then I'm done with part B. So I'll go to part C. Let me read part C. So we'll have part C. So let me read it. But see, they're saying, determine the sensitivity of the project to its net present value when revenue and cost are adversely varied at 8.5%. So variance is 8.5%. Yeah, sorry, we continue. So we are to do part C, the sensitivity. So we'll start with the base case. We'll start with the base case, NPV. So allow me to write the base case, NPV. Yeah, before we check on the sensitivity. So base case, NPV. Yeah, so the base case NPV is this NPV that we got here. Yeah, the workings here. Yeah, so I'll copy this. I'll copy all that up to NPV. Yeah, because we want to see the sensitivity. Sorry. Let me select that up to the NPV. So I'll just say Control C, then I'll copy it down here. Let me see. Yeah, so I'll copy it here. Control V. Yeah, so I have the values there. So I'll copy everything once again. So I'll start with here the revenue. Then that revenue, let me just copy the values. So I'll copy this and we'll have all those values. So I'll go to cost. Yeah, we are just copying the values because we want to use this case NPV to do the sensitivity analysis. Yeah, so we'll copy the original data. Copy the original data. Then here we have depreciation. We'll have 13,500. Yeah, so that's okay. So we'll come to initial cost. Also, you just copy. This is just the normal copying. There's nothing much. Then you will put the value there. Then here we have the initial working capital. Then we select the value. Yeah, we just copying. Yeah, we just want this information to be available down here. So we are just copying everything. Yeah, and you can see even the changes in working capital. So the salvage value, we'll also copy it. The salvage value, it was how much? It was 20. Yeah, it was 20. Yeah, so NPV must be this, 20,908. So I think because we have copied, yeah, so I'll do it again. So just equals to NPV. Yeah, just always do it so that you confirm. So I'll pick the rate, which is 11%. Sorry. Okay. Pick the rate, which is 11%. Then I'll put a comma. Sorry. Yeah. I'm just calculating it. Yeah, let me just do it again. So I'll pick all that. Then I'll add back this. Yeah, so it's 20,908. Yeah. So this is the best case NPV. So we want to check the sensitivity with a variance of 8.5% on revenue and cost. So I'll start with revenue. So I'll just write here revenue. Yeah. What they mean is if you vary, the sensitivity is all about if you vary revenue at 8.5%, what will happen to the NPV? Yeah. How will the NPV change? That's the sensitivity analysis. So I'll start with the revenue. So revenue, I'll just copy this once again. Yeah, so let me paste it here. Yeah, so I'll just paste it. Let me see if I can copy the formulas. No, let me paste. Yeah, so that's what we have. Yeah, so I'll just copy those values. So I'll just copy revenue. See, it will give me the same values. Yeah, that's okay. So cost, the same. Yeah, I've just copied this. Yeah, I'm just copying this information here. Then here we add depreciation. And the value was 13,500. Yeah, so up to there, it's okay. So we come to initial cost. We have 87,500. Then we have the initial working capital also. We are just copying this information before we do the actual sensitivity. So we'll have that value. I think everything has changed all the way. So salvage value, I'll also pick that salvage value. I think those values are correct. So the NPV is what I'll have to calculate again. So I just get the same. So NPV will pick the rate, which was 11. The rate was 11%. Then just do the normal. Yeah, I'm just calculating because I was not able to copy with the formula. So I'll just add that back. Yeah, you can see we get that value. So we want this to change. So revenue, we adjust revenue. And whenever there's variance in revenue, then yeah, if revenue is adversely affected, then it will reduce. Yeah, it will reduce while costs increase with this percentage, the 8.5%. So this is what we are going to do. We have base case. So I'll start at year one. So revenue is the only item that will change. These other items remains constant. These other items remain constant. So the only thing we're going to change is the revenue. So this is what I'm going to do. So I'll say equals to, and you recall, I'll use these values here for the base case. Originally revenue was 47 to 50 for year one. And for year 5, it was 54 to 20. So I'll use this value here for year 1. So I'll pick that value and I'll multiply by bracket 1. We are told that it is adversely affected by 8.5%. So it means that it will reduce by 8.5%. So I'll subtract the 8.5%. Yeah, I'll subtract the 8.5%. So where is it? Yeah, I'll select that. Then I'll close the bracket. So before I do that, because you can see under base case, these they are within row 63. So I'll lock that row 63. Then I lock the rate, the 8.5% completely because it will be constant all through. So I'll lock this and I'll lock this completely. Yeah, the rate for the variance, unlock it completely. Then I enter. So once I enter, when you come to my analysis, you can see I have 43 to 34 from now, from 47 to 50. So because I've locked that cell, I'll just drag all through. And these other values will change automatically. So when I drag, you can see the values have changed automatically. And the NPV changes to 90.54 automatically. So that's the sensitivity of the project to its NPV when revenue is varied at 8.5%. So I'll do the same to cost. I'll do the same to cost. So I'll copy that information once again. Yeah, and I'll just copy the information from the base case. Yeah, don't copy this to vary cost. Yeah, you copy from the base case. So I'll copy this once again. No, sorry, I was to copy only for base case. Yeah, so I'll copy only this up to NPV. Sorry. Control C. Then you just come and paste it here. Control V. Yeah, so I'll start with the first one, which was revenue. I'll have the values there. Yeah, you use the values for base case. Then cost, the same. Yeah, you have the original values. Yeah, as you do sensitivity. Yeah, pick that. Then you have depreciation. The original. Sorry, yeah. Depreciation. And the original depreciation. Yeah, then now we go to here we'll have the initial cost. It was this. Yes, you say you pick the original data. Then here we have initial working capital. Then you just select the original data from the base case, from the original data that we had. It's here. Yeah, so the salvage value here is what will change. So the salvage value, it was how much? The base case, the salvage value was 20,000. So I'll also put it there. Yeah, so this is what we are going to do. Yeah, so there's no need even of calculating the NPV. So let me just adversely affect cost, then it will change, or I'll come and calculate the NPV, the same thing. Yeah, I can as well calculate the NPV, then now I can go and vary. Yeah, the NPV which I will get is just 2908, the same here. Yeah, so let me just do so that we calculate finally. So for cost, we just come here, then I'll put my cursor there, then I just say equals to, but I'll use the value, the 10,000, which is found under base case. Yeah, you can see now, the revenue remain the same. Yeah, they're on the original data. The only thing that we are varying now is cost. As you vary cost, revenue remain the same, and those and other items like depreciation and initial cost, they remain the same. We only vary the cost only. Yeah, hizo zingine zina remain constant. So just say equals to, then you go to base case. So I select that 10,000. Then I'll multiply by bracket 1, but this time I'll add, because cost, if costs are adversely affected, then it means they increase. Yeah, so I'll say 1 plus the variance, the 8.5%, then I close the bracket. And because cost appears in row, you can see this is row 64. So I'll only lock that row. I'll only lock that row. But the rate of variance, I'll lock it completely. I'll lock it completely. Completely lock it, and I'll enter. So once I enter, you can see the value has increased from 10,000 to 10,850. So I'll just drag this because already I've locked correctly. I'll just drag those values and they will change automatically. So that I just come here now and calculate the NPV. So I just say equals to NPV. I'll take the rate, which was 11%. Then I put the bracket, the comma, then I'll select all that. Then I add back this. And we'll have 18,399 as the net present value. So you can see the sensitivity is that for when we vary, when revenue is adversely affected at 8.5%, NPV reduced from 20,908 to 9,054. But when costs are varied, it reduced from 20,908 to 18,310. There's no big margin there. Yeah, so that's the basis of doing sensitivity analysis. So thank you so much for watching. Until next time, bye-bye. And please subscribe to my channel. Let us get to 1,000 subscribers. And all the best as you prepare for your August exams. Thank you and bye-bye.